QuickBooks Online 2025, recording and advanced customer payment for when we get paid by a customer before providing any goods and or services. In our case, that being the inventory items here. The advanced payment from customers could also be classified as unearned revenue. This is going to be method number 1 for recording the advanced customer payment or unearned revenue. So get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project 5. We set up in a prior presentation. Let's open up those major financial statement reports, which are located on the left-hand side in reports. We're in the standard reports area, the favorites section, right-clicking on the balance sheet to open a link in a new tab, right-clicking on the profit and loss, otherwise known as the income statement, also opening that link in a new tab. Let's go to that middle tab, close up the hamburger in the modern view mode. We're going to select the drop down and select the custom dates for a 2-month time range going from 01/01/25 tab, 02/28/25 tab, selecting the display, drop down to the transaction date to see it in months, closing this out so that we have January and February of 25 side by side. Let's tab to the right, repeat the process. Hamburger, you need to be closed right now. Dropping it down so that we can get the custom dates, tabbing it over 01/01/25 tab, 02/28/25. Display, por favor, please drop down. We want to see the transaction date, months. Closing this out, and there we have it once again. Let's go back to the balance sheet. This time, we're going to imagine that we make a sale, but we receive a payment before we actually provide the inventory in this case. This is a type of transaction that will be common for a particular type of industry and one where we as bookkeepers want to keep in mind what kind of clients do we want to be picking up and be specializing in. And if we have a specialty of dealing with the types of industries that often have prepayments, we can make that kind of a specialty type of field. If not, we might say maybe those are types of industries we don't want to deal with as much because they have that complexity that doesn't fit into my general concept, my general template of clients that I would like to specialize in so that I can as best streamline those clients as possible. Just something to keep in mind. Let me give an idea of the story looking at the flowchart over here. This is a QuickBooks desktop flowchart, but we're using it for online purposes because we're just looking at the flow of forms, which would be the same no matter what type of software we're using. We are, of course, using QuickBooks Online. Okay, so we're going to imagine we're in the revenue side of things. We're trying to generate money. We're trying to have money ultimately, of course, coming in from the customer cycle or the revenue cycle. Now, usually what happens is that we either collect the money at the same point in time we do the work. It will be driven by industry. For example, if we're a restaurant, you don't get no food if we don't get no money, right? That's how it works. You pay us, we give you food at that point in time. So you have a cash register type situation. In our case, we're in a store and you're not walking out that door with the guitar unless you pay us, unless you're stealing it, in which case, if you're in California, you could probably do that and that's why we're going to move our shop to some other state at some point in the future. But generally, you can't really do that. No money, no guitar is the general idea. So that's going to be you can call it kind of a cash-based type of system, but really there's no difference between a cash and an accrual basis in that type of transaction because you're receiving the money at the same point in time that you did the work. Therefore, both methods would record in the same transaction at the same time. Or you have a situation where you get paid, where you do the work first. This is typical for service type businesses such as law firms, accounting firms, and landscapers and whatnot. You got to do the work so that you can bill how much it costs to do the work or how much time it took or whatever billing function you're going to use, and then send out an invoice, which is going to record the revenue before you get the payment. However, and then of course you'd receive the payment at a future point in time and make the deposit. But you can imagine a situation where you get paid first. You can see that that's unusual because the arrows in the flowchart don't indicate that process, right? It's kind of breaking the rules. You got paid before you did the work. That doesn't happen. When would that happen? Well, it could happen in situations like a concert, for example, where you're going to have an event in the future. You need to get paid before the event happens. People are going to buy the tickets in advance. You're going to get basically a received payment before you did the work, before you had the actual concert. Now, at the point in time then, from an accrual standpoint, that you get paid, then you haven't really earned the revenue because you haven't provided the concert. So you want to record it somewhere else. You'd have to record it in what we call unearned revenue or customer deposits, some kind of liability account, because if you don't put the concert on, then you should give the money back, or you're going to have to leave town because the mob's going to come after you. If you leave town because the mob comes after you, you don't have a business, you have a scam. You're remedying a scam type of situation, right? And so that's why you have to put it in there as, in essence, a liability, because you owe it back to them unless you... Now, other industries where this would be the case, the classic example is like a newspaper situation. Back in the day, when people actually liked the newspapers did a pretty good job. Even like the New York Times was like, it was actually, they did like a good job in like the LA Times, right? And so you basically paid someone to get to hire a kid that would ride their bike and give you the newspaper, and you're providing, a job to this kid and stuff and everything. It was great. And so that would be the idea. But when you order the newspaper, you're paying for the subscription in advance. So once again, you pay for it in advance, usually like a year's subscription or something. Then they deliver you the newspaper, and therefore they receive the payment and should be recording it as a liability until they actually do the work, in which point that's when the kid throws the newspaper at you, that you would transfer it from the liability account to a revenue type of account. Now, obviously, in today's age, what happened, that's one of the places that got taken over by kind of like the weirdness has happened, and then they started not hiring kids to deliver the papers, but basically people in vans that look very suspicious, and you don't really want to go near the vans that are throwing papers at your homes or anything like that. And then the newspaper themselves is nothing but a brick that they throw at you. It doesn't have any real value in it anymore. So you might say it's obsolete now. But also online services do this now, such as subscription models for software. So you might buy your newspaper from somewhat of a credible area, which might be some like new kind of media sources online, but still pay them with a subscription type of model, in which case you might buy it in advance, for example, and then they should be recording that once again as unearned revenue until they actually provide you the digital asset, in this case the paper. Any other kind of app generally will have a similar scenario. You can also imagine it with a rental property, where in rental property, they want to possibly collect the last month's rent because you might trash the place or something like that. So sometimes they call that a security deposit, which in theory they would get back, or you would get back, if you were the one giving the security deposit. So once again, they shouldn't record it as revenue, but rather a liability. Now, we all know they're not going to give the security deposit back, even if your apartment was pristine at the point in time of leaving. But even still, even if it was like the last month's rent, it would be unearned revenue in that case, still a liability, and so on until you leave, until the last month, right? Until they earn it. Similarly, if you sell something as we do, like a guitar, then if someone requests the guitar and we want to hold on to it for them, or possibly request it from a vendor, we might ask them for a down payment. So we might say, okay, we'll hold on to that guitar for you, or we will request it from our vendor for you, but we want the down payment first so that we know that you're locked in to the transaction. So that's a way of kind of locking people into the transaction. So that's when this kind of situation will basically happen. Now, we have the logistical problem of this, which is something we have to be aware of and make sure that we point out in detail here. I know it's a long story because people often get hung up on this point, in particular people who went through accounting textbook courses and want to record it with a journal entry, and they don't really see the links of the forms that kind of complicate things a little bit. In other words, let's say that you got paid before you do the work. Well, from a journal entry standpoint, it would be easy. I would just increase unearned revenue and the other side would go into the checking account. However, in practice, it's still a little bit of an issue because if I put it into the liability account of unearned revenue, I don't have a subledger account for unearned revenue typically within my software because it's a liability. And usually when I'm dealing with customers, the subsidiary ledger account is related to the accounts receivable account. So if I don't deal with accounts receivable, the subledger is going to get a little bit messy. That's one problem. And of course, when I receive the payment, I also have that same problem I have whenever I receive the payment of, should I put that directly into the checking account or should I combine it and then deposit it together with like a two-step kind of process? We're not going to deal with that second bit right now. We've talked about that before. But basically the idea then would be, well, the other thing that we could do that would be easier from a bookkeeping standpoint would say, let's put it into accounts receivable, making what you might call a credit balance to the accounts receivable, meaning it's like decrease in the accounts receivable, or it's something that we can apply to a future sale, right? That's what a credit balance means in this context. It's basically a credit, meaning the credit side of the ledger, which is usually a liability if there's nothing in accounts receivable, or it would be decrease in accounts receivable. But now we're going to record like a positive credit going up in the credit direction for a receivable. That's not correct from a bookkeeping standpoint, but it makes it so we can have one subledger that tracks everything customer related within it, which means that when I create the invoice in the future, it will be very easy to tie it out to the credit balance that's already in the system. So that's the idea. Now, that means that your financial statements will be kind of technically incorrect for the time period that it's outstanding, that you have that credit balance for that particular customer, because it shouldn't be a negative receivable, but a positive liability. However, it's just a timing difference. When you actually create the invoice, you'll be back in balance, and you can deal with that problem with adjusting entries at the end of the period if you need to for external reporting purposes, which small businesses might not even need to deal with because it's not an income statement issue. And for income taxes in the United States, we deal with mainly the income statement for small businesses reported on like a Schedule C. So it might not even have any impact on the financials and be logistically easier to do. Now, I just also want to point out that the advanced QuickBooks has different ways to automatically properly record it to unearned revenue. And one of the main differences between QuickBooks and its biggest rival, which is Xero accounting software, is that Xero has a system to properly record it as unearned revenue and still try to tie it out properly to a liability. However, it's still not perfect because you still have to have like to deal with the subledger problem for unearned revenue. So really, no matter how you look at it, the easiest thing to do from a bookkeeping standpoint is actually to have a negative receivable. All right, given all that, let me show you what I'm talking about. We're going to imagine that Mr. Anderson comes in. I'm going to go to the first tab, and they want to buy a guitar. So Mr. Anderson's in the shop. They want a guitar, and we're like, well, we don't have. They want a hideously colored guitar or something. Wants to be like plaid orange or something like that. Well, man, we don't tell them it's ugly. The salesperson's like, whoa, that's interesting, but we don't have that in the shop. So we'll have to order it from the vendor, possibly. We'll order it especially for you, but we really don't want to have that ugly guitar stuck in our shop, so we want to make sure you're committed to the sale. They don't say that, but that's like what they're in there. We don't want to, so we want to make sure you're committed to the sale, so we want you to give us a down payment before we provide you the guitar that we're going to order for you. Therefore, we're going to have a receive payment type of form before we actually have the invoice. Receive payment form. And I'm going to say this is going to go for Anderson, Mr. Anderson. I'm going to say, okay. And then it says Anderson's guitar payment doesn't have an open invoice, meaning what does the receive payment form do? That's the form that decreases accounts receivable. So how can I decrease accounts receivable if there's no invoice, which is the form that increases accounts receivable to tie it out to? Well, that's the point here. We're going to end up with a credit balance, a negative receivable tied to this particular customer in this case, which we can then pull into or tie out to a future sale, or in other words, future invoice. Let's go ahead and make the date here 02, I'll say 28, I think. Let's do 02/25, 25. The payment method. So however they're going to pay us, I'm just going to say cash. We're going to imagine cash here, but they could pay us in any kind of format, of course, as well. And if they paid us by cash or credit card, we have the same issue that we have seen before of, do I want to put it directly into the checking account, which I typically don't want to do unless it's like an electronic transfer or possibly a check because of the grouping problem. Therefore, we're going to put it into the clearing account of payments to deposit, which used to be called undeposited funds. Let's make the amount is going to be 300. So we're going to imagine that we're going to be collecting 300. Now, I just want to point out that in practice, if this is what we did in practice, you might first create an estimate type of form and say, hey, look, this is how much it would cost you with an estimate form, and then possibly create the down payment based on the estimate form, maybe taking like 10 or 20% as what you think is the customary down payment. So I'll show you that in a second. But first, what's this going to actually record? Well, it's a receive payment form. It's going to decrease the accounts receivable. And in this case, it's going to make a negative receivable for the particular customer in the subledger of Anderson Guitar. And then the other side is going to go into the payments to deposit. Let's save it and close it. And then we'll save this payment as a credit to your customer since blah, blah, blah. So that's good. That's what we wanted to do. So note that before we did that, if Anderson came in, we might first have gone to an estimate form. They're like, okay, I want this guitar. And we could have gone, okay, here's an estimate on that guitar. I'm not going to record this. I'm just going to give you an example so you can see what I'm talking about. And we could say it was for Anderson Guitar, and we could say that they want, an ELP, for example. And then the estimate would give us the value, and then we might be saying, look, I'm gonna record 20% of that or whatever is our custom as the down payment for the estimate. And then we could create the estimate if we wanted to go forward with it, possibly then creating the invoice from the estimate once we actually receive the guitar. But I'm going to close this out. I'm not going to actually make the estimate here. We're going to leave without saving the estimate. Let's see what was recorded by the receive payment form. Go into the balance sheet, refreshing the balance sheet, refreshing the page, and we're in the AR, the R account, the pirate account. Even though our customers are not pirates, we deal with good customers. They're going to pay us, even though I feel like we kind of treat them like we don't totally trust them here because, of course, we want the down payment because that's going to lock them in. But there's the 300, all right? And then we're going to go, okay, let's go back, trust but verify. And then we're going to say the other side went into the payments to deposit. There's the 300 on the other side, payment to deposit. Boom, shakalaka, bring it back. Let's go back to the first tab, and we can go into the sales area. And if I go into the customers side of things, we can go into Mr. Anderson down below, and we can see that they have then this credit balance in it. So let me show you that in report format so we get an idea of why this is kind of an issue. So let's go down to the reports, and let's go to who owes you money, and let's do a customer balance detail report. Customer balance detail, right click, open in a new tab. So this is the subledger breaking out the accounts receivable by who owes us the money. Now you can see that the total down here is a positive number of all the people that owe us money, all the customers, 19,511.50. That should tie out to what's on the balance sheet, 19,511.50. So it's not a negative accounts receivable. What you talking about? But if I go back on over here, you can see for this particular customer, Anderson, I have a negative 300. That's what I'm talking about. That's what I'm talking about. How can Anderson have a negative $300? That would mean that they owe us money. No, that would mean that we owe them money, right? Which we do, because we either owe them a guitar, but if we don't give them the guitar, we owe them the money back, right? That's why it's a negative receivable. The problem is that it shouldn't be bringing down an asset account. It should be increasing a liability account of unearned revenue. But if I add a liability account of unearned revenue, I would need another subledger related to customers to track the unearned revenue, as well as to track the amount in the accounts receivable, which is a pain because I only want one subledger that's going to be tracking all of the stuff that deals with customers. Therefore, it makes sense to have like a negative receivable here. It's just the easiest way to do it, no matter how you cut it. You can come up with cool software that will do it, but you're still going to have to transfer from the other subledger to this subledger when you take it out of unearned revenue and bring it over here. So it makes it a little bit messy from a bookkeeping standpoint, no matter what. But the financial statements are wrong. Why? Because it's understated. How can I deal with that? Well, the easiest way to deal with that is that at the end of the month, I could go in here and make an adjusting journal entry, as we will do in the adjusting process of the course, which will increase the accounts receivable by any of these negative balance amounts and put the other side into the liability account periodically so that it will be correct as of the cutoff date, and then we'll simply reverse it after the cutoff date, the day after, to get us back to this process, which is the easiest internally from a bookkeeping type of standpoint. So I think, so that's how we'll deal with it. Now, I'll show you another method later that will allow us to record properly the unearned revenue as we record it. But I think really practically, this is the easiest thing to do. Now, remember that if you are a small business, it might not even matter that you decrease the accounts receivable, right? Because you're not going to be reporting your taxes balance sheet. You only need the income statement. So it might not be a problem for small businesses, but you just obviously want to recognize what is happening here is the point. Okay, so that's going to be the idea on that one. Now, of course, what's going to happen next is we're going to receive a payment. We're going to invoice. We're going to get the guitar, and then we're going to invoice the client and apply the credit balance to the invoice. We'll talk about that in a future presentation. For now, let's do another one of these. Let's say that the word got out. I'm going to go back to the first tab, and I'm going to hit the plus button, and someone else wants to do the same thing. They want an ugly orange guitar too. Mr. Anderson started a trend of ugly guitars, and we're like, oh man, oh, that's great. You want another ugly guitar? Wait, not an invoice. I'll hit the drop down, and we're going to say we want to receive payments. Like, that's cool. We'll order one for you too. And this is why, even though Mr. Anderson was a pretty trusted customer, we had to stick to our policy. Because now if we just ordered the guitar for him without a down payment, then this other guy, which we don't trust as much, we'd have to do the same thing. And I don't trust this guy. So we have to say, well, this is what we did for Mr. Anderson. We need a down payment on this. So we might make an estimate and then use that to create or determine what the down payment should be, which we would then record with the received payment, which is what we're doing now for the customer of Sam the Guitar Man. So Sam the Guitar Man comes in, we're like, okay, we can do that. We can order you a guitar as well. And now notice as we're doing this, we're looking down here and saying, hey, wait a second, Sam Guitar Man, you owe us $930 from the prior invoice over here. And so we would probably want them to pay us on that before we order another guitar for them as a general business practice. This is why I don't trust this guy that much, you know? But I just want to point out that it's possible that you could enter a credit balance and not apply it out to the invoice, so that we're going to have another credit balance which we can tie out to another purchase that we're going to make at some future time. So I'm not going to check off that invoice. I'm going to keep it at $225. I'm going to say the payment method was cash. Once again, we're going to put it into the payment to deposit. We're going to say it was for $250, $250, which is not being applied to that invoice. And therefore, what are we going to have this happen? This is going to be a received payment transaction, decrease in the accounts receivable, but it's not being tied to this invoice, which is going to also make a little bit of a problem if we're doing our adjusting entries at the end of the period, which we'll talk about. And then the other side is going to go into payments to deposit. Let's save it and close it, and then we'll check it out. I'll show you what I'm talking about. Let's go to the balance sheet and refresh it. Refresh this thing. We only work with fresh stuff around here, just like my vegetables. I only deal with fresh stuff. 250. I'm spoiled like that. That's right. I'm spoiled, and I love it, being spoiled. I'm gonna go down. No, it's not spoiled. It's fresh. That's what I'm talking about. I'm going to go then into the payments to deposit, $550. There's the other side. Boom. Nothing going into the income statement yet, even though we got cash because we haven't earned it at this point in time. And then we have the subledger. If I go into the subledger, here's where the problem happens, because if I refresh this, you can see that for this particular custom, Sam the Guitar Man, we still have the invoice it's only showing the invoice, and it's tying out the invoice to the to the payment. But the problem is I don't see a negative number here. So when I do the adjusting entry at the end of the year, normally what would happen is I would look for all the negatives and say, well, that must be a customer deposit. But this one doesn't have a negative balance because he had an invoice outstanding and the payment was applied to it. Now that shouldn't happen that often, but it's possible and could make it a little bit more difficult to do our adjusting entries because we can't just look for the negative balances if that was the case. Let me show you internally. If I go to this one, go to the first tab, and let's go down to the sales item, and let's go into the customers, closing up the ham boogie, and we're looking for Sam the Guitar Man. Ba-boom. And then we're going to scroll down so we see the activity here. Here's the payment. So if I go into that payment, then, okay, notice what it did here is it assigned the payment already to the invoice automatically as a default function. Now, if you don't want it to do that, you can go into your settings up top and say, do not automatically assign out the payment. So what I'm going to do is I'm going to undo that right now. I'm going to edit this, and you can see what it did here is it assigned out the invoice. So I'm trying to say don't do that. I didn't check that off on purpose. And then let's see if we can save and close it. And it says you didn't select an invoice. We'll save this payment as a credit to your customer since you didn't select an invoice. We're going to say, okay, save transaction, boom. So now we can see it is in here as unpaid. And then we still have this invoice that's unpaid. So even though the balance is 6790 and we've received this payment, really we have two separate transactions because this 250 needs to be applied out to the next guitar that we're ordering specifically for this customer, and this one should be paid basically separately. So notice it gets a little bit wonky to tie all these things out internally, whereas in a textbook situation, then we just do things with journal entries and we don't often see the complexity of the subledger and basically tracking our customer information as closely as we would need to do in some types of businesses in particular, where we have to track the accounts receivable and advance payments, make sure that we do that well, because that's going to make our clients happy or unhappy, help us to get paid or not paid, as the case may be. All right, let's do this one more time. Now that we have the process down, I'm going to do this again. Plus button. Again, someone else is coming in and they're saying, hey, I want to do the same thing too. And we're like, man, I hope these people pay us because we're ordering a bunch of guitars for these people and they're all ugly guitars. This is going to be for Eric Music. Eric Music wants one of these orange guitars. We're like, all right, you guys better pay us. We want the down payment. So we might do an estimate to try to determine how much of a down payment we want. And then we're going to say that we have then cash. It's going to go into the payment to deposit. We're going to imagine this one is just for, let's say, $200 that we're going to get a down payment for. Once again, no invoice to apply it to. Therefore, what's this going to do? It's going to be a received payment, so that will decrease the accounts receivable, but result in a negative receivable for the subledger of the particular account for the customer of Eric Music, the other side going into the payment to deposit. Let's save it and close it, and then save it. So once again, it's going to make a credit balance. That's what we want. That's what we want to happen. Let's go back to the balance sheet, run it once again so we can refresh it, going into the AR, the pirate account. ARG, the pirate guitar. They even ordered the orange pirate guitar, so that's also making it scary that they're going to pay us, because pirates often, they don't follow the rules, man. They don't pay you sometimes, and you're like, dude, what? I don't accept rum for payment. I want cash, you pirate, for crying out loud, man. The other side went into the payment to deposit. Let's go into this one. Try to pay me with rum, for crying out loud. And let's go then to the subledger for the A to the R. And then we can see Eric Music payment, boom, 200. So once again, we have this negative amount easily, clearly seen in the subledger saying, hey, something's wrong. That shouldn't be a positive or negative asset, but a positive liability. Let's go to the first tab and in the customers, go back to the customers and check out Eric Music here. Eric Music has 200 unapplied, which we can apply next time. That's the credit balance in the account that we can apply to the invoice that we'll make in the future. All right, one more thing before we wrap this up. If I go back to the balance sheet, we can see that in this, what used to be called undeposited funds, now being called the payment to deposit, the clearing account, we have $750. We're imagining we're holding on to that cash. We want to get that into the bank because there's a lot of criminals around here. There's pirates right outside the door. So what you got to do is we got to get our bouncers together. We got to make that trip to the bank so we can put that in the vault, because hopefully, you know, the bank will hold on to it. They don't either. They get robbed too, but at least in California, at least they have insurance there, so they get the money back. And so let's go back to the first tab. So we're going to go over here and we're going to hit the plus button, and we're going on down to the bank deposit. Bank deposit. It's going into the checking account on 2/25. At the end of the day, we're making the run, the dangerous run to get that money in the bank, baby. We're going to select all of them. And so 750 is going to add up to all of them. What's this going to do? Well, it's going into the checking account. Checking account's going to increase by the 750, which is the amount that we expect to be on the bank statement, which will help us with the bank reconciliation. It's going to decrease the clearing account of funds to be deposited or payments to deposit. And that's going to happen individually so that we can easily tick and tie the increases and the decreases. If there was any kind of fee, we can put the fees down below so it would tie out to what's on the bank statement, such as would be the case if it was a credit card situation where they take the money out for the services. But I'm happy to pay them because then I don't have to hold on to the cash, and I'm less likely to be mugged and beaten to death by criminals and thieves. The ladrones. All right, let's save it and close it. All right, and then we're going to go back to the balance sheet, and then let's go ahead and refresh this one. Going into our checking account, check out the checking. And we have the 750 going in at 225. Boom. Goes in that one amount that's going to be found on the bank statement. And then the other side is going to be going to the payments to deposit, which is now at 0. I can't click on it in this format, but if I go back to the switch to the classic view mode, one of the benefits there being that if I can still click on it when it's a 0, although now it changed the date range, which is kind of annoying, but it's right there. Let's go into it then, and then we can see that it basically put the deposit in individually so that I can easily tick and tie them out to the payments that made it go up, which in this case were the payment forms that made it go up. So that's kind of nice. QuickBooks does a great job. That's one of the things it does possibly better than its competitors, in particular Xero in that case. Although Xero has the capacity to properly record the unearned revenue, and they both have their pros and cons. All right, so this is where we stand at this point in time. Here's our balance sheet accounts. Boom. And then here's the profit and loss. Let's refresh that one. Nothing happened to it because although we got cash, we didn't earn it yet. We haven't earned it. I don't recognize it until I earn it. I do the work. We're honest workers down around here. I get things done before I record the cash. Let's go to the first tab. That's why customers like us. That's why we're transparent. We do it the way it's supposed to be done around here. I'm going to hit the drop down and go to reports. Let's go to trial balance, and check out where we stand. Closing up the ham boogie. I want to be in the classic mode because the trial balance isn't working right. If you're not in the classic mode, 010125 to 022825. Let's see it in months. Run it. So now if your numbers tie out to the February 2025, which is basically year to date, February 28, then that's great. But if not, check your January numbers and see if they tie out, in which case you have a February data input problem. If there's a problem in February but not January, then try to increase the date range to include things that might be input after the date. If that's the issue, drill down to the source document, change the date to the proper place, which would be February of 2025, you would think. So we have, of course, the balance sheet on top of the income statement, assets, liabilities, equity, income, and expense. Assets going from the checking account down to the contra asset of furniture and fixture, the accumulated depreciation. Then the liabilities going from the AP, accounts payable, down to the loan payable. The payroll liability, then the equity accounts from opening balance equity to owner's equity, and then, of course, the income statement, income accounts, 3 of them, minus the expense accounts, starting with cost of goods sold, the expense related to the inventory, and then other operating expenses. And at the bottom, you got other income and other expenses.